Today, we'll split this recording into two sections. First, we want to talk about the conventional wisdom you hear from financial advisors, from the news, from the press. And then we want to tell you what are the smart decisions for the long term for retired investors. So make sure you stay to the end because we're going to give you some specific recommendations for retiree portfolios. So Neil, tell me, what's the conventional wisdom that people are hearing?
Well, actually, I just want to differentiate the conventional wisdom by advisors mostly is not bad, which is to stay the course. All right, we're going to get to that. We're going to get to a better approach than that. But the worst thing that people are hearing are things on the news, they're hearing on YouTube, radio, whatever. They're hearing sensationalist information trying to get people interested and scared in order to do something. We're actually in order to keep listening, and they're trying to capture the eyeballs. They don't really care how bad the advice is. So it's the advice on the media that's really terrible and dangerous and expensive.
So you're saying that the media always has something, like every day they'll have something, oh, you got to look at this, you got to listen to this, you got to listen to this, where most investors would be better off just turning that off for about 5 years and coming back.
Yeah, absolutely. For example, what you're hearing today on, again, any number of podcasts or YouTube stations, whatever, is how bad the market is, and the market has done very poorly. The S&P, depending on when you're watching this, the S&P was down 17% for the year, maybe more. The NASDAQ is down over 24% for the year, maybe more or less, depending on when you're watching. So it's easy to get scared, and you take different stocks like Amazon, Facebook, you name it, they're down 25 to 50% each. So these media channels are pouncing on that and trying to play on people's fears and get them to do something which is really detrimental to their long-term financial security.
Let's. Are they in fact telling people to do something wrong? Because look, a lot of retirees are in the situation where their portfolio is down and they need to take money from their portfolio. So people do have reason to be concerned, correct?
Well, people are concerned. People are concerned. They're worried. Whenever they see the values drop, that's a problem. However,
but what do people do if they need to take money out of their portfolios and their stocks are down, 30%?
All right. Well, for example, we've had previous videos where we've talked about the bucket system, where you have different buckets for different, your needs over the next 12 months, your needs over the next 36 months, over the next 5 years, 10 years, whatever, different buckets, different investments. Make sure that you tap into those buckets, and the shorter term bucket's going to be much more conservative. So even if your portfolio is down, let's say 20 or 30% overall, the bucket that's got the cash in it isn't down, right? I mean, it's stable. So
right.
So people freak
yeah,
out.
So it's really critical.
Go ahead.
Yeah, it's really critical for people to watch that video on the bucket strategy to understand why you'll never be in a position to have to sell stocks in a down market for cash. That's just that's bad planning if you wind up in that situation, because it can always be avoided.
Yeah, it can always be avoided.
Now,
go ahead, sorry.
So tell me this, I see probably 3 times a week, there's some talking head on the TV talking about inflation, and people should buy these TIPS, Treasury inflation protected securities.
Right.
So what's the deal with that, and what's is that really good suggestion, or is that just like more the hype?
Well, it feels really good when you see the market dropping and then you've sold out at a loss, but then your money you feel is protected by these tips. But I think it's a long-term terrible investment. Let me ask you, Larry, have you ever bought tips? And we've been friends for 30, 40 years, been through all kinds of markets. Have you ever bought tips for your own account?
I've never owned a treasury security. I just have never seen a reason to buy them that they would have been better than something else that I could do.
Right. Okay. So generally, I mean, I agree with that. But so to be specific, there's a few problems with the tips. First of all, it's not as advertised as you see by this slide. Even this year, the mutual funds that have purchased tips have lost money. First, let's back up a little bit. What is a tip? Treasury inflation protected security. So basically the way it's designed to do is that when interest rates go up, the interest rate that it pays goes up. It adjusts every 6 months, and that or it goes down, right? If interest rates go down, the interest that you would receive would go down, and theoretically that's supposed to keep the principal stable. Most bonds, their interest is fixed, right? So if interest rates change, the value of the bond fluctuates. In this, they just reverse that. So, in theory, it's really good. But if you buy funds that buy tips, you can see by the slide over 1 year, it's actually lost money, even though interest rates have gone way up. And if you look at the tips investment over 10 years, it's lost a lot of money when you compare it. It hasn't made any money compared to, the S&P 500 with its ups and downs. It's just made a lot more money, as you can see from that slide. So,
okay, so what you're saying is these Treasury inflation protected securities, they seem really good in the short run because supposedly they're supposed to protect your capital, and then you get interest that adjusts to inflation. So when inflation's up or interest rates are up, you get more. The reality is that the principal value of the funds or the individual securities over time have performed poorly relative to the stock market. So what may look good in the short run, over the long run, has not made investors better off at all. Is that it?
Yes, that's historically been the case. Obviously, it's no guarantee of the future. And want to take this opportunity to remind our audience that they should speak to their own financial advisor before taking, investment action. But this is the same argument when it comes to when people talk about superinflation. Oh, let's buy gold. Let's buy commodities. Those things. Okay, even if you get it right with tips or commodities or gold, you got it right for maybe 6 months or a year. People tend to hold on to these investments for, this in your work with clients. People buy something, they don't switch out of it after it doesn't make any sense anymore. They hold on to it forever. So, remember that, when you make an investment, if you look at your own portfolio and say, yeah, I've had that security for 5 years and this security for 10 years and this for 15, you might think you're only making a short-term investment while inflation is high. But the reality is you're probably buying into something for a long time. And inflation, it's high now. We don't know how long that's going to last. So that's
I remember my grandfather, I think it was in the 60s or the 70s, he used to follow this commentator named Howard Ruff. And the guy was always talking about how the sky was going to fall in. And so, people that followed this guy, and he was pretty famous at the time, they were always, doing things that were really conservative and making sure they didn't have their money in the market and buying gold and things like this. And you know what? 30, 40, 50 years later, the people who've made the money, you could have just bought an index fund and just gone away for 50 years, and you would have been far wealthier than following the doomsayers and the newsletter writers or any of the nonsense that you hear in the media.
Absolutely.
I don't know why people fall for that stuff. It's pretty amazing, isn't it?
Well, it is amazing, but I think it's because that we're emotional beings. And when we have an emotional response, we want to put some kind of an emotional Band-Aid. Give me ice cream, give me chocolate, or give me tips. Some kind of an investment that will make it feel better. It's the same thing.
All right, so if people shouldn't be, so if selling stocks is a bad idea, when they're down during a period of inflation, and buying tips, is not a good idea, or gold or something to catch this short wave of inflation, what should people be doing then?
Well, number one, they should have a good bucket strategy in place. That's number one. If they don't have that, they've got to, do not pass go, do not collect $200. Get a good bucket strategy in place so that you have more flexibility with your withdrawals.
And by the way, I should just mention to people that not only will you be able to see our video on the bucket strategy, but you'll want to see our next video, which we'll produce next week. Make sure to hit the subscribe button and the bell icon so that you'll get notified when our next video comes out.
Right.
Sorry to interrupt you. Please proceed.
That's all right, Larry.
A shameless plug.
A shameless plug. All right. So the second thing that you need to do is sort of in connection with that strategy is be very aware of how you're making your withdrawals, right? Third, so that you want to withdraw money from the in a down market, you want to withdraw money from the most conservative funds that you have. So for example, if you don't have enough cash in set aside in your bucket, and the market's down, take money out of the bonds, take out of your bond portfolio. Again, talk to your advisor first, but take out of your bonds instead of the equities that have really gotten beat up. If you don't have money in bonds, take money out of your more conservative stocks to let the other stocks have a chance to recover. But also, very important, take this as an opportunity to look at your overall portfolio. If you've got stocks that are way too aggressive for you just because you've made a lot of money over the last 5-10 years, that's great, but you're 5 or 10 years older and we're in a different situation. Now might be a really good opportunity to shift your risk level down a little bit, and be a little bit more, even within the equity portfolio, be more conservative, more dividend paying stocks.
Okay, so do you have any recommendations, specific things that retirees should be looking at, stocks or funds?
So there are 3 funds that I'll just share with you. These are ideas. They are not investment recommendations. We strongly recommend that listeners and our audience talk to their own financial advisor before they make an investment decision. First one is the iShares S&P Value Fund. This is a fund that focuses on undervalued stocks with low cost, and those are large cap stocks. When it says undervalued stocks, that's what they say they do, and what, just like they say one person's ceiling is another person's floor. So undervalued stocks is very subjective, but this is what they say. And if you compare the different numbers, like the PE ratios, etc., which we're not going to go into, you can see that relatively speaking, the stocks held in this fund are relatively value stocks. The second idea is the large cap value, the Vanguard Value Index Fund. Again, large cap value focus on the top 70% of all domestic stocks. And it is a very well diversified fund, but again, they're focused more on income as opposed to growth. So there's income focus, not necessarily value focus, but also when you look at their numbers, their stocks, their positions are more value, they're cheaper than the overall market is. And the third idea, just real quick, is the U.S. Wisdom Tree Fund. This is a fund, again, large cap. They're going to focus on U.S. equity, but they're again focusing on high dividend yielding stocks. So their focus again is going to be on the dividends, not necessarily the growth. So number one, you want to look at all of these funds. They're very similar objectives. Their performance has been very different. So you want to dive in yourself and look at the particulars, the PE ratios, the performance, how long the manager's been there, and of course you want to speak with your own financial advisor before you make an investment decision.
Okay, so if you had to summarize everything up, kind of the 3 tips that you'd leave people with today, what would it be?
Well, again, number one, have a bucket strategy in place. Think long term. That means that just because your portfolio is down, it doesn't necessarily mean it's time to sell everything and buy tips or go to cash. But use it, and then third, use this as an opportunity to look at your overall investment strategy and and make sure that the investments that you hold are appropriate for your long-term goals and your emotional needs for security. I think those would be three really good takeaways. And then talk to your advisor about it as well.
Great. All right. So watch for our upcoming video. We're going to have some more investment recommendations and talk about how we pick individual investments. And we think you'll find that really enlightening. So next time on Retirement Crusaders. See ya.
Bye.